Understanding Qualified Exchange Accommodation Arrangements, a comprehensive guide. Qualified Exchange Accommodation Arrangements, QEAA, are vital components of tax deferral strategies for real estate investors. Familiarity with these arrangements can enhance an investor's ability to navigate complex tax scenarios associated with property transactions, specifically under Section 1031 of the Internal Revenue Code. What is a Qualified Exchange Accommodation Arrangement? A QEAA is a specialized approach in the realm of 1031 exchanges, where a neutral third party, known as the Exchange Accommodation Titleholder, EAT, temporarily holds a relinquished or replacement property during the exchange process. This arrangement provides flexibility in timing, allowing investors to defer capital gains taxes on the sale of their properties while simplifying the complexities tied to like-kind exchanges. Key takeaways. 1031 Exchange Basics. A 1031 exchange allows investors to defer taxes on capital gains by exchanging one property for another of like kind. Role of an EAT. The EAT facilitates the temporary holding of one property within the arrangement, which can be crucial for meeting the strict timelines associated with 1031 exchanges. Tax deferral. This arrangement provides a way to defer realized capital gains or losses, assisting investors in navigating their tax liabilities efficiently. The mechanism of Qualified Exchange Accommodation Arrangements. When an investor engages in a QEAA, the process typically involves the following steps. 1. Identification of properties. The investor identifies a relinquished property they wish to sell and a replacement property they wish to acquire. 2. Transfer to EAT. The relinquished property is transferred to the EAT, which temporarily holds it. 3. Acquisition of replacement property. The investor can then acquire the replacement property while the EAT manages the relinquished property. 4. Final exchange. Upon ensuring that all the necessary criteria are met, the EAT can transfer the relinquished property to another buyer, and the exchange is completed. This arrangement notably increases flexibility, allowing for better timing and reducing stress typically associated with simultaneous closings of multiple properties. Properties and their relationship to QEAAs. The significance of QEAAs became recognized by the IRS in 2000, establishing clear guidelines for compliance with 1031 exchange regulations. Initially, these arrangements were mainly referred to as warehouse transactions, since they involved temporarily holding properties. Limitations post-TCJA. The Tax Cuts and Jobs Act, TCJA, of December 2017 impacted the nature of properties eligible for 1031 exchanges. Post-TCJA, the exchanges are limited solely to real property, excluding other asset types like machinery or intellectual property. For a successful exchange, both relinquished and replacement properties must be classified as real estate. The properties must be held for investment or for productive use in a trade or business in the U.S. Properties are considered like-kind as long as they share the same nature or character, regardless of variations in quality. For instance, an apartment building qualifies as like-kind to another apartment building, regardless of whether either is improved or unimproved. Tax implications of QEAAs. While QEAA offers tax deferral benefits, it's critical for investors to be aware of the reporting requirements and potential taxable events. Here's a breakdown. Reporting requirements. Investors engaged in 1031 exchanges, including those utilizing a QEAA, must report the exchange using IRS Form 8824, which details the specifics of the exchange and calculates the amount of gain deferred. Taxable events and BOOT. In a 1031 exchange, BOOT refers to any cash or non-like-kind property received during the exchange. Receiving BOOT can trigger a taxable event. Here's how it works. If additional cash, liabilities, or property not regarded as like-kind are given or received in the exchange, it triggers a taxable gain. The taxable gain is recognized only to the extent of the BOOT received, while the taxpayer does not recognize a loss. It's essential to note that if depreciation recapture applies, the recognized gain may need to be reported as ordinary income. The role of the Exchange Accommodation Titleholder, EAT. The EAT plays a crucial role in the successful execution of a QEAA. As the holder of simplified legal title over the property, the EAT benefits from the tax advantages associated with like-kind exchanges. According to IRS guidelines, any property that is transferred from the EAT back to the investor is treated as property received in the exchange, effectively linking both properties in the 1031 exchange context. Conclusion. A qualified exchange accommodation arrangement is an invaluable strategy for real estate investors looking to optimize their tax situation while facilitating property exchanges. By understanding its mechanics, limitations, and tax implications, investors can make informed decisions that align with their financial goals. It is always advisable to consult with a tax professional or real estate expert to navigate these transactions successfully and ensure compliance with the IRS regulations surrounding 1031 exchanges.